If you're watching energy markets right now, you're not just seeing volatility, you're watching a power shift in real time. In less than half an hour, crude prices surged more than 10%. Natural gas contracts in the Northeast spiked sharply. The Canadian dollar strengthened instead of falling. Traders didn't react to a rumor. They reacted to a collapse, a high-stakes energy negotiation between the United States and Canada that just unraveled, and it may reshape North America's economic balance for years. Here's what happened. Less than an hour before markets moved, senior officials from both countries met in Washington to finalize what had been described internally as a generational energy framework. Hundreds of billions in planned infrastructure investment, expanded pipeline capacity, joint LNG terminals, refinery upgrades, and long-term supply commitments designed to cement continental energy stability. That framework is now off the table. According to officials familiar with the meeting, the American side introduced revised terms at the final stage, terms the Canadian delegation had not previously agreed to. Those revisions reportedly included pricing adjustments below projected market rates, new oversight mechanisms tied to export destinations, and expanded emergency authority affecting cross-border infrastructure operations. From Ottawa's perspective, that crossed a line. Prime Minister Mark Carney declined to accept the revised structure. Within minutes, Canada announced it was suspending new energy expansion projects directed primarily at U.S. export growth, while honoring existing contracts. In the same statement, Ottawa signaled it would accelerate discussions with European and Asian partners regarding future capacity development. Markets immediately recalculated risk. To understand why, you need context. The United States imports a substantial portion of its crude oil from Canada, more than from any other country. Cross-border pipelines operate near capacity. Refineries in the Midwest and Gulf Coast are calibrated specifically for Canadian grades. Natural gas flowing into the Northeast relies heavily on Canadian supply corridors. Existing contracts remain intact. No taps were turned off, but freezing expansion in a demand growth environment changes the forward outlook dramatically. Energy pricing is not just about today's barrels, it's about expected future supply. When anticipated expansion disappears, futures contracts absorb that uncertainty instantly. That's what drove today's spike. Now let's address the deeper implications. The original framework under discussion was intended to lock in long-term cooperation, not just for fossil fuels, but for LNG, nuclear fuel supply, grid interconnection, and even renewable coordination. Private capital had begun modeling investments tied to that stability. When stability becomes conditional, capital hesitates. Large infrastructure projects require decades of predictable policy. Pension funds, sovereign wealth funds, and private equity don't commit billions into pipelines or export terminals if cross-border politics can rewrite terms overnight. So this isn't just about oil prices, it's about investor confidence in North American reliability. The White House has not publicly detailed the full content of its revised proposal, but officials maintain it was structured to protect U.S. energy security and ensure fair terms for American consumers. Supporters argue that renegotiating pricing and oversight protects national interest. Canadian officials counter that sovereignty over pricing and infrastructure control is non-negotiable. From their standpoint, selling energy at mandated discounts or allowing emergency override mechanisms alters the partnership dynamic fundamentally. This is where leverage enters the conversation. In commodity markets, suppliers with alternative buyers carry structural leverage. Canada is not a marginal exporter. It is a top-tier energy producer with access to Atlantic and Pacific coast development potential. European markets are actively diversifying supply after years of geopolitical turbulence. Asian demand remains strong. If even a portion of future Canadian capacity shifts east or west rather than south, long-term supply architecture changes. Infrastructure, once built, rarely reverses direction. At the same time, the United States remains one of the world's largest energy producers itself. Domestic output is high. Strategic reserves exist. LNG export capacity continues expanding along the Gulf Coast. This is not a zero-sum collapse scenario, but integration matters. For decades, the U.S.-Canada energy relationship operated on assumed continuity. Pipelines expanded incrementally. Regulatory friction remained manageable. Political disputes did not routinely threaten structural supply flow. Today's breakdown introduces a new variable, unpredictability, and markets punish unpredictability. Let's talk about regional impact. Midwestern refineries depend heavily on Canadian crude blends. Northeastern states rely on Canadian natural gas during winter peaks. If expansion projects remain frozen while demand rises, supply bottlenecks could emerge seasonally, particularly during extreme weather cycles. Price sensitivity would likely be regional before national. At the same time, Canadian provinces also depend on U.S. refining capacity and pipeline networks. Interdependence cuts both ways. Neither side benefits from sustained escalation. That's why the next 72 hours matter. 3 possible pathways now sit on the table. First, recalibration. Behind closed doors, negotiators return to previously agreed baseline terms. Minor concessions allow both leaders to claim victory domestically. Expansion resumes. Markets stabilize. Second, controlled tension. Existing flows continue, but expansion freezes persist. Both governments test leverage rhetorically while avoiding direct disruption. Prices remain elevated but manageable. Third, escalation. Tariffs or regulatory barriers enter the equation. Canada accelerates non-U.S. export infrastructure. U.S. policymakers explore alternative import mixes. Supply chains reconfigure slowly but permanently. History suggests economic interdependence pushes leaders towards scenario 1. But politics sometimes overrides economics in the short term. There's also a psychological layer. President Trump's negotiation style often emphasizes leverage through market access. The premise, the U.S. consumer base remains the ultimate magnet. But commodities differ from manufactured goods. Raw inputs cannot be substituted instantly without infrastructure. Prime Minister Carney approaches negotiations from a financial stability background. Central bankers think in terms of long-range structural positioning rather than immediate optics. One leader thrives on decisive public framing. The other favors calibrated structural pressure. Those styles collided today, and energy futures reflected that collision. Beyond pricing, the geopolitical dimension looms. If Canada deepens energy partnerships with the European Union or key Asian economies, it diversifies exposure. That does not mean abandoning U.S. trade. It means reducing concentration risk. From Washington's perspective, safeguarding supply security remains paramount. From Ottawa's perspective, preventing external control over domestic resource policy is equally critical. This is less about hostility and more about boundary definition. The phrase energy sovereignty is now central on both sides. For viewers at home, the immediate takeaway is this: existing energy supply continues. There is no cutoff. There is no overnight blackout. But expansion uncertainty introduces volatility. Heating costs, gasoline prices, industrial fuel contracts all respond to expectations. If negotiations stall for weeks, forward contracts will price that risk more aggressively. If resolution appears quickly, much of today's spike may retrace. Energy markets move fast. Infrastructure moves slowly. Politics sometimes moves unpredictably. Today was not about one meeting. It was about whether North America's most integrated energy partnership can withstand hardball renegotiation tactics in a politically charged climate. Investors are watching. Governors are watching. Energy executives are watching. And so are global competitors. Because when major partners show friction, alternative alliances quietly strengthen. This story is still unfolding. Statements from both governments are expected. Negotiations may resume privately. Corporate pressure may accelerate compromise. But one thing is certain: leverage has been tested publicly, and markets have already responded. The question now is whether this becomes a brief spike in volatility or the opening chapter of a long-term energy realignment. Stay close to this. The next move will determine whether today was a warning shot or a turning point.